Welcome everybody, and special thanks to Mohnish for being part of this conversation. And of course, Mohnish needs no introduction. Maybe he can introduce me instead. um, Mohnish, I thought I'll kind of structure this in three parts. Really, the first, I just it's not just me who's very impressed with your Dakshina story. Warren Buffett wrote a letter saying that he wants to benchmark his annual reports with the Dakshina annual report. So maybe if you can start a bit with your Dakshina journey, just maybe those of you not seen your videos and the website, I would highly encourage everybody to take a look at the incredible work that Mohnish has done with Dakshina, and I think that's kind of very similar to his investment philosophy, which is very very long gestation period, but kind of the super massive returns over the long term. And maybe we can start with that. Then maybe we can move to the regulatory changes, the tax laws, etc. A little bit on the regulatory side, and then we'll come to Mohnish's investment philosophies, and of course we'll end with kind of some Q&A depending on how much time we have. So Mohnish, maybe we can start a little bit with your Dakshina story.
Sure. So first of all, Sandeep, it's a pleasure, honor to be here with you and all the listeners. I think it's wonderful. First time I'm on Twitter Spaces, so that's good. It's a growth opportunity for me. Uh, yeah, I think the the story with Dakshina actually is one where I did not have a choice. So basically, if you are even a slightly above average investor and you spend less than you earn, then just the nature of compounding and a long runway and so on will basically put you in a situation where in the end you will have more assets than you can consume in a lifetime, and which is a good problem. And so when you end up with more assets than you can consume, you really have only two choices of what you can do with those assets. Like my dad used to say that no one has succeeded in even taking a pin with them when they leave planet Earth. And so the only two choices you have is you can either give it to your gene pool, or you can, somehow recycle it back to society, or some combination of the two. And large inheritances to your kids and relatives actually do more harm than good. So, like Buffett says that if you're Jesse Owens' son, the sprinter, you shouldn't be allowed to start 100-meter dashes at the 40-meter line. He said it's okay to start at the 10-meter line, but not at the 40-meter line. So when for us, the journey has been really exciting because we started from zero. And the process of building and such is what makes life exciting. If you bestow very large amounts on your children, uh, in effect you're putting them in a welfare state. They basically are like kind of a IV drip into their arms, and it's going to significantly suboptimize what potential they could achieve in their lives. So basically, there's more harm that happens if you think about it from a gene pool point of view. And so then you get left with the other option, which is give it back to society. And giving it back to society has some challenges. So the challenge is that the kinds of problems you have to deal with if you're trying to help humanity are things like poverty, education, healthcare, environment. Uh, each of these, and there's several others, but each of these are very tough nuts to crack. And there's been a lot of well-meaning people in the past, and there's been trillions of dollars by governments who have gone on to attack these problems, and some of it has worked. A lot of it has not worked. So in investing, what happens is that we get to choose our spots. We get to choose which company we want to invest in, and we can let 99% of the or 99.9% of the kind of market go by the wayside, like not interested. But when you're looking at philanthropy or helping society, you are forced to confront these very tough problems. And so the rules become different. So one of the things that I realize is that uh, if I were to wait till I was 70 or 80 years old to try to recycle assets or whatever else, uh, basically I would have very little energy left, and my only choice would be to just write a check to somebody. And so Dakshina actually started when I was 42 years old. I think I'm now going to be 58 in a couple of weeks. And my intent was that, or my thinking was that trying to do work in India while hanging out in shorts in California is a recipe for disaster. So I actually thought that uh, Dakshina will probably have like 10 years of spinning its wheels, getting ripped off by a lot of people, etc. And then maybe after 10 years, after having paid a big tuition bill, we would actually understand what to do. So I wanted to give enough time for that learning. And what ended up happening actually with Dakshina is that we got traction right away. We got traction in a few weeks. And, uh, you know, there were a few people who ripped us off, but nothing material. And we were able to obviously, eliminate those entities, whatever, from our universe. And basically, the idea is that we don't really have a choice here. And what I wanted to do with Dakshina is that if I'm going to give money away, I do care about the fact that the money is utilized effectively. And that's, like I said, it's very hard to do in these areas. And so the rules for nonprofits become different. One of the important rules you have to follow is you have to be very willing to fail. So in investing, we go low risk, high return. We try to minimize risk. In philanthropy, you have to go high risk, high return. Like Buffett would say, you in baseball terms, you should swing for the fences. Don't go for singles. And if you swing for the fence and you miss, it's okay. Keep swinging for the fence. And so basically, you have to be bold and you have to be willing to completely fail. And that's the only way to really move the needle. And so basically, the way Dakshina was set up with the idea that every year a certain amount of money, and I followed Buffett's formula. He gives away 5% of his Berkshire shares every year to charity, and Berkshire's value goes up by more than 5% a year. So his net worth keeps going up, and the amount given every year keeps going up. But he could actually live forever and wouldn't really run out of money. So I followed something similar when I started with 2% of our assets going every year, and then increasing that as the net worth grew. And the idea was that that money, once it went to Dakshina, I was very willing that it would disappear, not get used properly, whatever else, but try to learn and improve. And what I find with most nonprofits, which is so disappointing, is I actually did not want to start Dakshina. I wanted to find an entity that existed that I could just write checks to. And when I looked 15 years ago, and in the last 15 years, I've looked a lot more. I've come away disappointed. I haven't found a single organization that really, I mean, there were a couple I think I got to know, but they didn't really have funding issues, um, that really thought about it in these terms or focused on the highest social returns, maximizing input to output, and all of that. And so was just forced to go into Dakshina, and we ended up, because we copied the model from Anand Kumar of Super 30. So it was a well proven model. We just scaled it, and some great people showed up, and it worked, which is awesome.
Right. Monish, also, if you can just spend 30 seconds on what Dakshina does for the benefit of the people who don't know about the work. Is just, I've seen your lectures with the students, I've seen the website, I've seen some of the stuff that you've done. So, for just kind of an introductory for those people who don't know about Dakshina, that would be a good this thing point.
Yeah, Dakshina is purely focused on education. That's the one area we decided to focus on. And specifically within education, we have a model that gives us a very high ratio of money invested versus output generated. So if you guys are familiar with the Super 30 model, Anand Kumar basically identifies 30 really smart poor kids in Bihar, and he coaches them for a year for the IIT entrance exams, and then you know something like 90 to 100% of them get accepted at IIT. It's a very high acceptance rate versus the 1 or 2% that IITs are taking every year out of the entire pool that's trying to get in. And so we cloned Anand's model, and we basically scaled it. So instead of taking 30 kids a year, we're taking more than 1,000 kids a year, and we are like between 60 and 80% of the kids every year get accepted to either the IITs or medical schools or AIMS and so on. And basically, these kids, the demographic they are coming from is most of the parents are illiterate, farmers, laborers, rural India, and so on. Typical income, family income is less than $100 a month, maybe less than 5, 6, 7,000 rupees a month. And most of the parents don't even know what IIT is. And we get a very large portion of the kids, like I said, 60 to 80% get accepted. And now, since we've been doing it for about 15 years, we track the kids after they finish, and they, of course, also want to be connected with us. And now, a lot of the Dakshina staff and faculty is our alums. Our alums have gone all over the world. They work at all these top class companies, Microsoft, Amazon, Google, and so on. And many have joined the IAS and the government and so on. So they've actually some have quit IIT and been funded by top VCs for startups and such. So actually, the output, we spend about $2,500, $3,000 per kid over the 2 years they're with us, 1 or 2 years they're with us. And what we get out of it is quite significant, because the increase in their lifetime earnings is exponentially more than that. And we still haven't seen the kind of the crest of that wave. I think a lot of these kids, when they hit their 40s and 50s, is when we'll probably have some billionaires in their ranks and so on. So that's kind of what we do.
Yeah, this amazing work, and of course they're open for donations. So uh, anybody on this chat wants to donate even a small amount, it would be greatly appreciated. So just moving on to the second part of the conversation is where we are really in terms of the markets, the macro, interest rates going up, some a regime which we've not seen for 40 years. The tax laws are changing rapidly. There's kind of global coordination. So just if you can just give us a broad sense of where you think we are going in the next 6 months to the next maybe 6 years, really. And what your take is in terms of your investment philosophy, or given the completely changed circumstances.
Yeah, so these are questions I don't spend a lot of time thinking about trying to come up with answers, because I don't think I can come up with any kind of answer that's better than anyone else. And what I try to spend my time on is I try to figure out uh, whether I can understand certain businesses, and I can maybe understand the trajectory of those businesses. So it's hard enough to try to figure out just a trajectory of a given business. Very hard to figure out these big macro calls, but every so often you run into situations where um, it it lends itself to being able to be understood, and with a high probability you can you can predict likely trajectory and so on. And basically, I think the bottom line is that there are if you go back and look at different businesses that have been listed for a long time and so on, um, many of those businesses have done well regardless of what was happening in the economy or interest rates or unemployment or government policies, um, just because they had um, a model and engine that transcended all that. So, in general, I believe that for most businesses, micro situations, things that affect the business directly, are much more relevant for an investor to understand than macro considerations. So if one can figure out, the two or three main factors that will drive the outcome of a business, that's really the most important thing. So
Right.
I don't, I don't tend to
Right.
try to figure out these other questions you're asking.
Right. Right. No. So in fact, I saw your comment of being small brain. I'll come to that in a few minutes. I just want to. I was asking that question given the context that your I think your first um big kind of public showing of your record happened after the dot-com bubble, immediately after, really, right? So Nasdaq went down almost 80%, and you're giving 30-35% returns every year for several years, probably a better part of the decade after that. So are you saying that you had kind of really no sense of the macro, and you really didn't care about the macro at that point of time, or did you kind of look at you said that you had a sense of the bubble a few months before the others, but can you give us a little perspective about uh, your macro sense back in 99 and 2000?
Yeah, sometimes we get to such extremes in the market that things become obvious. I think it was quite obvious in '99, early 2000, that we were in a period of extreme euphoria with a lot of bubble-esque type situation in a lot of different areas. And I remember like in early 2000, actually, I visited Microsoft headquarters. I had an early investor who wanted me to come, and he wanted me to introduce me to other possible Microsoft and ex-Microsoft people to possibly invest with me. So I made a trip to Seattle, and I went to Microsoft, and I was talking to a lot of these people. And of course, in what they had seen from 1976 till 2000 was just straight non-stop upward trajectory of Microsoft stock, nothing else. And they continue to believe that that would continue to do well. And I told them that it was probably not the smartest thing in the world for them to have all their income coming from Microsoft and 90% of their net worth in Microsoft stock or something. And they just looked at me like, you really don't understand the company or whatever. And the thing is that it was at an extreme. Microsoft's market cap at that time was amongst the three largest market caps in the world, I think north of 600 billion. And the cash flows they were generating were, single digit billions or something. So it was trading at like 70, 80 times earnings or something. Not growing that much, but it was a very good business. And I told them, I said the business will keep doing well, but everything has a price and everything has a value. So in 99, 2000, it was obvious that a lot of things were very frothy. There's a book your listeners may enjoy. It's called Trend Watching, and it was written by a guy named Ron Insana. And he was a CNBC anchor. Usually, CNBC anchors are not good writers. but he chronicled that book just chronicles bubbles. And when you read that book, you'll see that bubbles are extremely common. They happen all the time. Different asset classes, different geographies, they're happening all the time. And the reason they happen is because humans vacillate between fear and greed. So at any given time, we could have big bubbles, little bubbles, bubbles in different areas, whatever. And 99 2000 was a time where there was a massive bubble in the dot coms, but there was also a bubble in stocks like Coke and General Electric and Microsoft. I mean, these companies actually had real earnings and such, but even they were very stretched valuations. And at the same time, in 99 2000, when this was happening, a lot of very basic, non-sexy businesses got really cheap. So the day the Nasdaq peaked, I think March 9, 2000, was the day that Berkshire Hathaway hit a multi-year low. I mean, literally, people were selling Berkshire Hathaway stock and buying Pets.com. And Warren Buffett would be on the cover of Barron's, and they're asking, "What's wrong, Warren? Why aren't you participating?" That sort of thing. So actually, Pabrai funds did really well. We started in '99, and first year we were up like 70%, which was through the crash, and we continued to be, uh, 20, 30, 40% a year for the next several years. And that's because I was buying things like funeral homes at 2 times earnings, and uh, steel mills at 3 times earnings, and that sort of thing. There's very non-sexy stuff which was very stable, and it did really well. So there are times we can clearly see these things. Like I did not see the financial crisis coming. I saw the dot com crash. I didn't see the severity of the financial crisis coming till it was well into it. When you look at the current situation, some things are obvious to me, and it actually doesn't matter if I'm wrong about these things, because I'm not, I have no bet in this area. So, for example, I think crypto is a bubble. Now, whether it turns out to be a bubble or not is irrelevant, because I have no long or short position in crypto. But I think it appears to me, given the fact that bubbles are common, and all of these bubbles, they always have a kernel of truth at the core. So crypto is a bubble. We have things like GameStop in the US is a bubble. AMC is a bubble. And so we don't have widespread bubbles today. And of course, we got into frothiness in a small part of the tech sector, which is now corrected somewhat. I'm not sure if it's corrected fully or what will happen there. It's, again, I don't have bets in that area, so not very relevant. Uh, so I don't think the situation today is as extreme as 99 2000, but we do have areas of the market that are bubble-esque, and over time those will get back to where they need to be. But I think what investors would be better off doing is not fixating on these things, and just try to focus on things that they are able to understand really well. And sometimes when they can understand something really well and the pricing makes no sense, then that can be an opportunity.
Mohnish, I know you said it in your past talks, but if you can tell the funeral story, is so fascinating. I mean, I'd love for listeners to hear that, maybe a shorter version of the funeral story. It's very fascinating.
Oh yeah, so my first book, Mosaic, is out of print, but all the chapters in that book are PDFs. They're on my blog, Chai with Pabrai. So you can go to chaiwithpabrai.com and you can pull down those chapters. There's a chapter on the funeral business, and so I'll get to your question in a second. But in general, um, funeral businesses are really, really good businesses. So, for example, we have a company in the United States called TJ Maxx, and TJ Maxx has done really well, probably like 20+% a year for like decades. And what they do is they buy out clothing that is kind of excess and surplus from different manufacturers where they had a extra line they made or things didn't get sold, and they buy them at very low prices and then they put them in their stores. And so when you go to a TJ Maxx store, it's not like a normal clothing store where you can find the same stuff, everything. It's kind of like almost like a like a treasure hunt, where the inventory keeps shifting. Like sometimes they might find 100,000 jeans that were produced extra, and they'll buy those and put them up and whatever. So every time you go into the stores, the kind of mix of products is different. But because they are really good at this, picking up these excess kind of things. So the companies who are in the either the funeral business or the recycling business, um, they do very well. And even if you look at the US as a whole, for the longest time the US had a huge advantage over the rest of the world because it has a very advanced bankruptcy law system and the Delaware courts and all of that. And so that system, which now India is putting into place with NCLT and so on, what that system allowed is that companies that got into trouble, you had this cleansing recycling process that was very efficient, where the debt would be converted to equity or be recycled or whatever else, and the company would come out the other end. It would still be running and with new owners and kind of a new life. And that rebirth process is really good. So again, the people in Delaware, those law firms, and Kirkland and Ellis and all of them, those law firms, I mean, those lawyers are making like 10 million a year because again they were in the recycling and funeral business. So there are many businesses in different areas that you will find that basically end up in effect being in this funeral recycling business. The the specific investment I made in the early 2000s, there were two roll up companies in the US which had bought up thousands of funeral homes. So in the US, you had all these mom and pop funeral homes all over the place. And these two companies, Service Corp and Stewart Enterprises, they bought up all these funeral homes. They took on a lot of debt, and they got very overloaded. And then the music stopped. So people got really concerned whether they can really manage their debt or what's going to happen. They also made a bunch of bad acquisitions where the cash flow was nothing and they paid a lot and so on. And so what ended up happening is that these companies, and again, we had the dot-com bubble and all that. No one wants to be in the funeral business. Um, these companies were like, I think Stewart Enterprises was market cap was 200 million and it was producing 100 million a year in cash flow. And it had $1 billion in debt. But after paying the debt service, they were still producing 100 million. So I said, we can own this business for 2 years. We get our money back basically in earnings in the next 2 years. And then they, in the next few months after I bought it, they sold off the European business, which was not generating any cash. They got 400-500 million with that and paid down debt. And in I think less than a year or maybe 18 months, it was a multi-bagger and such. So that was you know one of the lowest rate of business failures is funeral homes in the U.S. because I don't know who's going to die in St. Louis next year, but I know how many are going to die. That's a pretty precise number, and we know they're going to die. And there's like when you have your favorite uncle who's passed away, and you need the last rites done in the U.S. You're not going to go hunt for the low bid. You just want those things done well. So it's a business that actually has good economics, and a lot of people, 22-year-olds don't aspire to go into the funeral business. So it has limited competition and it has tradition, so it works out really well.
Yeah, Mohnish. So how you saw how you found this company is also an interesting, if you can, interesting bit. So
Yeah, so I subscribe to Value Line, and Value Line has different lists. Like they have different screens, like physical, not electronic. So one of their lists is the companies with the lowest PEs, and I found these two companies with sitting at a PE of 2. And I had read a while back that the lowest rate of business failure is funeral homes. So I said it's very interesting. We have these companies that are sitting at 2 times earnings, and they're in a business that never fails. And So that prompted me to take a look at them. And when I looked at them, I said, wow, this is amazing. We'll go for it.
Yeah. Great. So I'm going to make it a little interesting. So I'm going to throw 5 allegations at you, okay, Mohnish?
All right.
And you have to defend yourself against each of these, okay? Uh, and again, these are insults, but these are taken from your own speeches, so you can pardon my affront. Okay, so the first is that you're quite unoriginal, right? You love cloning, and you gave the example of McDonald's and Burger King, and how they look for locations. So maybe you could talk a little bit about how being unoriginal has helped you in your investment journey.
Yeah, I mean, I think that Munger actually endorses cloning quite a bit. I mean, he says that, and I think in investing, no one is smart enough to figure it all out themselves. So one of the things that is a huge advantage in investing is if you can look at what other people you admire and trust have already put their money into. So if I know someone is a really good investor and I can see what their portfolio is, and it's already gone through one filter where they put their own money on the line, that's a better place to start looking for businesses than to start with a list and start going with the A's and then the B's and C's and so on. I think in investing, because the data set is so large, there's 50,000 stocks, you need some shortcuts. There's no way you can study 50,000 stocks, entire lifetime. You won't even be able to study 1,000 stocks in a lifetime. So, so you need shortcuts, and one of the great shortcuts is to look at what great investors are doing, and like for example, in about 4 years ago, I made my first trip to Istanbul, and I noticed the Turkish market was very many different areas of screening very cheap, and it had a lot of issues, macro issues, whatever else was going on. But I have a good friend there who is a hardcore Ben Graham type investor. And I told him, hey, I'd like to come to Istanbul and spend a week just visiting every company you invested in. And would you be okay with doing that? He said, oh, it'd be a lot of so much fun. Let's do it. So I went and I visited Istanbul, and that was really fascinating for me because just going in and looking at the different businesses, like there's a Coke bottler there in Istanbul, which also owns 49% of the Coke bottling market in Pakistan and 10 other countries. So they're pretty large outside Turkey, but significant within Turkey as well. So there's just different businesses like that. And then my second trip, he took me to this company, which basically, he was telling me the market cap is $20 million and the liquidation value was like $700 million. And I said, is it a fraud? Like, what's going on here? And he said, no, they're, as far as I can tell, they're straightforward, honest people. He had an investment in the company. And I couldn't find anything wrong with it. And actually, the liquidation value was really easy to figure out because they had a bunch of warehouses. You could go to any commercial realtor, and probably in the afternoon, he would give you approximate prices for those properties. They're very prime, 99% leased. Amazon, IKEA, Carrefour, DuPont, these are the tenants and all of that. So I really, really couldn't understand what was going on here, but I couldn't see anything wrong. And then Turkey is a market where the retail is all gamblers. The average holding period is 9 days. Most investors are holding just for a few hours. It's a dream market for value investors. And I was surprised. I spent $7 million and we ended up with one third of the company. And it's 12 million square foot of warehouse space. They're the largest freight train operator in Turkey, largest truck fleet in Turkey. I think the footprint is worth over $1 billion, and given how well they allocate capital, is probably worth $1.5 billion. And the whole thing was going for 20 million. And when we invested in Turkey at that time, there was a lot of macro. Even now, there's a lot of macro problems. The lira had just collapsed from 3 lira to the dollar to 5 lira. So when we invested, it was 5 lira to the dollar. Now it's approaching 17 lira to the dollar. So 3 years, it's gone from 5 to 17. Our investment in dollars has gone up 5x. I mean, in lira, it's gone up a lot more, but who cares about that? So that was a situation where I focused purely on the micro, and I focused on these assets that were basically, these assets have an international price because, there's steel in there, there's concrete in there, there's land in there. All of those things have an international price, and it's prime, and it's got these long leases and all that. So it was actually, and what I find in Turkey is everyone and their brother has exited that market. So I don't have much interest in looking at, the US markets. I think they're either fully valued or maybe overvalued, etc. Maybe some parts are a little bit undervalued. But if you go to a place like Turkey and you look at the top 100 companies there, I mean, they are so widely mispriced because of this, all this major uncertainty. But when you look at things like the Coke bottler, uh, such a resilient business. I mean, Coca-Cola company owns 20% of that, and they have this, 50% market share in 8, 9, 10 countries or something. So, um, I mean, like I said, we want to focus on things which the world is not focused on, which make sense to us, and so on.
Right. So the second charge against you is actually, I think you addressed it already, which is you call yourself small brain, which by which you mean you look at the companies which are undervalued. But maybe you can take us into the journey of obviously you had a incredible run post the dot-com bubble, and you had quite a successful run even after the financial crisis. So maybe if you can just tell us a bit uh, about how you address the challenge that the markets can be insane longer than your ability to make profit out of mispriced assets. So how do you deal with that challenge? I mean, we saw one big hedge fund go virtually bankrupt because they shorted AMC. So how do you tackle situations like that when it can continue to remain mispriced for maybe half a decade or more?
Well, the first thing is that one should not use leverage. So there's a few rules which I have followed for a very long time. So leverage is a bad thing. I think the thing is that the problem with leverage is that you may not get to play out your hand. So markets can do, because these are auction driven entities and prices gyrate. I mean, if you took a dart at every company listed on the NSE or BSE and just threw that dart and just look at the 52-week range of the price, it might be, 100 to 300 rupees or 200 to 400 rupees. It's a huge swing. Whereas if you look at like an apartment or a flat in Mumbai, and you ask a realtor every day to give you a quote what the price of the flat is, it may not change by even 10% in a year. And so it is the nature of auction driven markets that there will be wide swings even when there's nothing going on from a macro perspective. And of course the swings will get even wider if there's uncertainty and fear, Ukraine and all these other things going on. So we really don't know the extremes to which markets can go. And so what you want to do is you want to set yourself up so you can play the next day and you're not kind of swept out or taken out. So not having leverage is a very good rule. Not shorting anything is a very good rule, because shorting is kind of dumb, because the maximum you can make is you double your money, and the maximum you can lose is bankrupt. I mean, there's no limit to how high a stock can go, as we saw with GameStop and AMC. I mean, those companies, the valuations make no sense. The hedge funds that did the analysis, they did it correctly, but they are gone. So I think, and investing actually is not, the small brain is. It's not a. It's really not a IQ. It's not a game where the highest IQ wins. The most important thing is temperament, patience, and like this company in Turkey, you didn't need more than 100, 120 IQ to figure out that it's really cheap. I mean, there was nothing special about that. But you needed to have a temperament where you were willing to buy when others were not, and that you're willing to hold for a very long time. And that's a lesson I'm still learning. I'm still learning that holding periods matter. And I'll give you a quick story on that. In '95, when I first started investing, I was just investing my own money. I had a total of $1 million that I could put into the market, and it didn't matter what happened to it, and so on. And I put most of that in the U.S. market, and there was quite a bit of technology stocks and such because that's what I understood well. But I carved out $20,000 and I opened a account with Kotak Mahindra in India, and out of the 20,000, I put 10,000 into an IT company, Satyam, and this was actually before Satyam had any of the fraud and all that came many years later. Um, and so 10,000 went into Satyam, and then the other 10,000 went into three other stocks. I I knew that at that time in '95, the Indian postal system was useless. And if people wanted to get anything anywhere, they wouldn't need to use private courier services. And there were two listed courier companies, Blue Dot and Skypack, and I put like 3,000, $3,500 into each of them. And then last minute, as I was kind of doing all of this, because I had been interacting with Kotak, and actually it's interesting, Falguni Nair was my contact at Kotak in London when I was opening the account and such. And I was really impressed with the Kotak team. And I really was impressed when I came to India, Nariman Point, met all these people. And so I said, I didn't even look at the financials much. I said, I'm going to put about 3,000 into Kotak. So basically my four bets were Satyam, Blue Dart, Skypack, and Kotak. These four bets, right? And then this whole .com thing, and I got physical shares, these dilapidated share certificates because there was no demat at that time. And I just stuck those shares in the bottom drawer of my office. I said, I'm never opening that drawer. Just let it sit there forever. And what happened is, I think after 4 or 5 years, I noticed that Satyam, which I had bought at 40 rupees a share, was sitting at like 6,000 rupees a share. And I said, let me just do an analysis what this thing is actually worth. Because all these things, like I told you about Microsoft, all these things that become very euphoric, they had spun out a .com, and I could not make head or tail of the valuation. None of it made any sense to me. So I said, you know what, we're not going to keep this in a drawer forever. We're going to sell this. And I also had concerns whether these certificates were worth anything and whether we'd be able to repatriate the money back from my NRI account, all these kind of uncertainties. So anyway, I sent the stuff to Kotak, and the 10,000 had become 1.5 million. By the time I sold, it was over 7,000, and we sold, I think, within 10% of the top. So that was like a huge home run. Like 10,000 became 1.3 or 1.4 million. And then I had these other three stocks, and they had done nothing. They were all sitting flat. The 10,000 I had put in was still sitting at around 9 or 10,000. And for no good reason, and this is, so dumb, no good reason, I sold all three. I just said that it is not written in the cards that you're going to have 300 baggers or 3 or 400 baggers. I said, we got a great home run in India, and we cashed out at the top of a great bubble, and life is good. So I sold Kotak and Blue Dart and Skypack. So Kotak went up from then till now 500x. Blue Dart is 300x, and Skypack went down 90%. So that never worked. But out of four stocks, three were more than 100 baggers if I had the patience. And it was so stupid. It was so stupid to sell it because there was no reason. I just simply I didn't need the money and such. So I think that the biggest lesson I've learned in all these years of investing is the most important skill is to be patient. And if you're patient, amazing things happen.
So that gets me to the third charge: is that you're very lazy in your investments. Again, your quote.
I'm not as lazy as my friend Guy Spear.
But yeah, but is the moral of the story really you need to be even more lazy than you are?
Yeah, I think there was a study done in Fidelity did this study where they looked at the accounts that the investors made their own investment decisions and they wanted not relying on an advisor or someone. And they studied the returns those accounts had generated. And they found a set of accounts where there was hardly any activity and those accounts had done the best. And then they discovered that a large number of the accounts that had done truly the best, the customers were already dead. Okay. So there had been no trading because
Wow.
the owner of the account is not alive. Okay. So, and those accounts had done the best. Okay. The first investment I made when I started my investment fund, the very first one, July 1st, 99, it's a company in Silicon Valley called Silicon Valley Bank. And I was trying to find a way to play the bubble where there was upside with no downside. I was looking for ways to play it. And Silicon Valley Bank is a really well run bank. And they used to take warrants. So they only, bank, they only clients were venture backed companies. And whenever they made a like an equipment loan or something to a venture backed company, they would obviously charge the interest rate, whatever else, but they would also take warrants. And in Silicon Valley, even if you're a masseuse, you get warrants. If you're a waiter, you get warrants. Everyone gets warrants and stock options. And so they had no disclosure on this huge basket of warrants they had, but we knew it was known that they have this basket of warrants, and all these dot coms were going public. And so I saw that this company is trading close to book value, but there's this huge unknown asset sitting there. So I put 10% of the fund and we started with $1 million, 100,000 went into Silicon Valley Bank. And a few months after that, they started to sell the ones that had gone public. Like they got out of the lockups and all that. They started selling those. And it was a multiple of what their normal earnings were. I mean, it was this very significant amounts that were coming out. And then people got clued in that this thing actually is a huge, massive, gift that keeps on giving. And I think I got a 2.5 times my money in a year. Like whatever, 100,000 became 250,000. And in my infinite wisdom, I sold because obviously I thought this whole bubble and everything is going on. But Silicon Valley Bank, what I failed to appreciate was that it was an incredibly well-run bank, and even today, the franchise that they have, there's no other bank that caters to the venture-backed companies. It has compounded from 99 to now at like 26% a year, right? And I never captured any of that, right? I mean, like it would be like buying HDFC or something or buying Kotak at that time. And so the thing is, like I say, old too soon and wise too late. This is the interesting thing about the investing business. It's a very forgiving business. If I go through my list of all my mistakes and screw ups, we'd be here for several hours. But in spite of all that, things work out, and which is what makes this business wonderful.
So one thing I've not understood is, you're willing to go to Turkey and inspect factories there, but how come you just have one US investment? I would assume that you would be able to find at least a few values within the place where you live. So where does that come from?
It's coming from the place that I am very focused on large multi-baggers. So I used to be. I mean, this is how I used to invest when I first started in '95, and that's why I bought those, you know, Blue Dart, etc. Because I just saw that runway was going to go on forever. Um, and I switched. I switched in '99, 2000 because things got so euphoric and crazy. And what I should have done is switch back in 2009. 2009 would have been the perfect time to switch back to compounders. And so I'm not really interested in making an investment where I can double my money. What I'm really interested in is, can I hold something for 10 or 20 years and can we get 30, 50, 100x of what we put in? And so when you have a framework where you have a, you know, that type of horizon, you know, two or three things become important. One is you want to be investing in businesses that have these long runways and have very strong, you know, staying power and so on. And there may be a large number of businesses like that, but I'm not able to see them. So there's a very small sliver of them that I'm able to understand. So when I look at the U.S. markets, it's difficult for me to, in this environment, even with the corrections we've had recently, to find things that would go up even 5 or 10x in the next 5 or 10 years. I think even that's hard to find.
Mm.
And I find that if I go to a place like Turkey, um, most of the businesses I think you're better off not touching, but there's a sliver of them that are amazing, and I think they're going to transcend all the macro headwinds. So
Right.
that's why I end up where I end up.
So you're not living up to your name, your moniker of being lazy. So I think it is a lot of hard work. It seems. You're
Well. So I think the thing is that it's. I don't think of it. You know, Tom Murphy just died recently. He was, I think, 95 or 96. He ran Capital Cities ABC, and you know, and then they sold it to Disney. Anyway, a wonderful guy. The New York Times had a long obituary on him. Very close friend of Buffett. You know, he said it to one of the speeches he gave at Harvard, that he's never worked a day in his life. You know, he was just so excited every day to go to work and do deals and solve problems that he never really thought he worked. And you know, my job description really is reading and thinking. So I really don't think of it like, um, if I went sightseeing in Turkey, I would not be that happy. But if I spend a week, you know, visiting 15 businesses, that's an orgasmic experience. So to me, it's not work. I think it was just understanding these things, figuring them out. So the idea in investing is, the job description is really reading and thinking, and not acting. So actions need to be very infrequent.
Yeah.
And
No, so,
if you need to be curious, and you need to be willing to understand different things, and then that can make it a great life.
right. So I mean that brings me to my fourth charge against you, which is that you're boring. So it seems that you are, I think you go through very intense periods before your investment, and then you after that it's you probably kind of just lock it and forget it. And then I think obviously you read a lot, you think a lot, you kind of quasi philosopher. You're also a teacher. I've seen your sessions, um, uh, and of course you're obviously as a philanthropist. It takes, I guess, some part of your time as well. So, how do you respond to that? Being kind of lazy and boring, as you said, is you said dead people are the best investors. So, is is there another way? People spend, at least most investment professionals spend 18 hours studying uh, companies, reports, etc., etc. You have a very different style from those people. So, and of course, it's a successful style. Uh, so maybe you could talk a bit about the fourth charge.
Yeah, so even now Buffett spends maybe 10, 10 hours or more a week playing bridge, and and I probably spend a similar amount, maybe 7, 8 hours a week, maybe 10 hours a week playing bridge. It's awesome. Uh, and actually, this was I had an interest in bridge, and started playing it um, about 7, 8 years before I even heard about Warren Buffett. So I know this did not come from him. It was kind of two independent things that happened to coincide. And you know, of 2 or 3 years ago, I think maybe 2 or 3 years ago, Buffett made an investment, a set of investments where he bought 5 to 10% stakes in a bunch of Japanese trading houses. And it wasn't a lot of money. I think it went like $6, $7 billion went into that, which is very small for Berkshire. But the interesting thing is that when he did that investment, the entire amount he invested, the entire 7 billion he invested, he borrowed in yen in Japan, and he borrowed it at like 0.5% a year or something. So here's Berkshire Hathaway sitting with 100 billion of cash, earning nothing, sitting in US treasuries earning nothing, like 0.25% or something. And he goes and invests in these 3 or 4 Japanese companies, and he doesn't put up his own money. He borrows the whole thing. And the reason he did that was that these companies had a dividend yield of 7-8%, and he probably also understood that they were cheap. They were sitting quite cheap. Now, what has happened in the last 3 years is all of them have moved up like 50 to 70%. Okay. And he's paying that 0.5% interest, and he's collecting 7% dividend. So, this is what Munger describes as, he says, Warren has a very large brain, and that brain needs to be active, but it needs to be active in a manner that is not detrimental to Berkshire Hathaway. So this Japanese bet is not going to do anything for Berkshire Hathaway. But what it does is it soaks up brain power for Berkshire. It is this kind of funny, interesting mathematical game where he is able to show the world that, hey, look, here's something that was sitting there where I couldn't put a lot of money into it, but I could put 6-7 billion, and without any risk, really, I'm going to make several billion on it. I mean, the annualized return on that and the annualized return on equity invested is infinite. It's a crazy bet, and he's done this in the past. Like one time, he issued Berkshire. He issued debt for Berkshire at a negative interest rate, right? And he issued it just to show that it could be done, right? So there's a bunch of activities that Buffett engages in, which is basically to soak up extra horsepower. Because if you don't soak up the extra horsepower, it's going to lead to negative results. So Bridge soaks up some extra horsepower. These Japanese bets soak up extra horsepower. He's done a bunch of these weird things, special situations and things. He does some of that in his own personal account. All of that soaks up horsepower. He bought a bunch of cheap Korean stocks one Saturday afternoon looking at a report, and none of that moves the needle. But it basically, what Munger told me is that those activities are really important because they make sure that nothing weird happens with that extra horsepower.
Thanks.
So we have to be very, we have to find ways. So it's good to have Dakshina, it's good to have Bridge, and most important, it's very important to talk to Sandeep.
So that brings me to the final charge. I've called you lazy, small-brained, unoriginal, and boring till now. And the last one requires the most detailed response from you, which is, you mentioned that, even if with 5% of Warren Buffett's capacity, you can actually be a superb investor. Can you maybe tell me, from what I hear, even though you've been, you've been very open about your investment philosophy, it appears to me that 99.9% of even professional investors can't replicate what you do. And second part is really what you do is not scalable. If you had $500 billion tomorrow, would you be able to be a Mohnish Pabrai investor?
Yeah, so the second answer is no. I mean, all investors are going to do worse as the size of the assets go up because your universe shrinks dramatically. I mean, I think one of the reasons Buffett was doing that Japanese stuff is because basically at this point Berkshire needs to put up 30-50 billion at a time to move the needle. And what kind of equities can you buy where you could put 20-30 billion to work? Well, you need to buy companies you want to keep it less than 10%, over 200 or 300 billion in market value. And how many companies are there? Like 20-30 companies, and that's it, you're done. and how many of those are great values, etc. So it becomes really hard. The large sums uh, make it really hard. But I think um, Einstein said that compounding is the eighth wonder of the world. If you are a know nothing investor and you just bought the index, I mean, if you look at the BSE index, from whenever till now, or you look at the Dow, the S&P, whatever, the S&P has given us 9% for a very long period of time, 100 years plus. And like I said, you're spending less than you earn. You're putting the money away, even at the 8-9%, whatever. The power of compounding takes over. So you don't need to compound at high rates. There are three variables that control the eventual wealth, right? One is the most important of the three variables is the length of the runway, and then the second is the rate of return, and the third is the amount of capital you start with. So it's a combination of those three. And Buffett gives an example. He gave an example in the 1950s in his investment letters to his partners about the Minuet Indians, where he said that the Dutch in I think 1622 or something, they bought the island of Manhattan from these Minuet Indians for the equivalent of $20. And people listen to the story and say, oh, the Indians got taken advantage of. And Buffett says that if the Minuet Indians had a investment officer, and they gave the investment officer this $20, and they said, please invest it for the benefit of the tribe. And let's say that guy wasn't so bright, and he could do like 7% a year, right? Now, if you do 7% a year, rule of 72, your money will double every 10 years. And if you take a 100-year period, it's 10 doubles. That's 2 to the power of 10. That's 1,000. 1,024, but let's say it's 1,000. So if he was doing 7% a year, by 1721, it would be 20,000. By 1821, it would be 20 million. By 1921, it'd be 20 billion. And by 2022, that we're at right now, it'd be 20 trillion. Okay? 7% for 400 years. And if you just take this thought experiment a little bit backwards, so let's say we started in 1522, going back 100 years. So $20 is 2,000 cents. Basically, it'd be 2 cents. So in 1522, if you had 2 cents, in 2022, you would have 20 trillion at 7%. So basically, the thing with compounding is that when you look at this kind of a situation, obviously, so like Buffett says, if people ask him, hey, if you could have only one wish, what is the wish you would want? He said, I really only want one thing. He says that when they look at my corpse, they should say, man, he was old. Because what he wants more than anything else is he wants the longest possible runway to compound. So, it's amazing. He started at 11 and now he's 91. So he's been running this engine at 14 or 15, he had like $5,000. And of course now it's more than 100 billion after having given away a lot of money. So what I'm trying to say is that the people, what they lose sight of is 6, 7, 8% returns, 9% returns are not anything to look down on.
Right.
Those are very robust numbers, and over a lifetime, we don't like the Minuet Indian just start with $20 and never get to add. You're making savings every year. And so the important thing is just to be consistent about it. And in the end, you can't help but get wealthy if you follow this consistently. So I think that's why Einstein calls it the eighth wonder of the world. I think compounding is magical.
Right. So let me just close with one final question. I was following your trajectory, and I found it very similar to Nick Sleep's trajectory in terms of, he talks about how the short end of the equity yield curve, there's a lot of competition, but there's very little on the younger term yield curve. Both of you went into philanthropy. He of course hung up his boots, and both of you went into long-term philanthropy, which has long gestation periods but outsized returns. And both of you kind of are in the business of teaching to fish rather than writing checks. So it's I don't know who inspired who, but it's quite a interesting journey. If you could just, the final question really is, in terms of him being a geography major and you kind of having a more of an engineering IT services background, has being an outsider helped as an investment professional as compared to a person who starts straight out of MBA, starts kind of managing money?
Yeah, it's a good question. I think I would have done much worse if I had followed. I mean, my teachers have been Warren and Charlie, and I never really worked in the investment business under anyone. So pretty much whatever I learned from them and Ben Graham, and I think that's it's a gift. It's a gift that they were willing to teach, and that everything is in the public domain that you could take it from there. I think Nick is miles ahead of me from an investing point of view. He really figured out a lot of stuff quite well, and a lot of it people don't fully understand. But uh, he's got some incredible wisdom on a number of fronts on his investing. Uh, I think he has overdosed on the Dakshina annual reports. He reads those, and I think maybe some inspiration may have come from that. But I think, like I said at the beginning, basically at the end of the day, you end up with this quandary where there are only two choices, right? You've got the gene pool or society, and I think he confronted that as well. And he likes race cars, and he races race cars on the track, and he's biked across China and done. He's a very adventurous guy on different fronts. But I think he realized pretty obviously that for him and his partner, that they really had to find a second an engine to give away the money, and we have a similar psyche in the sense that all of us want to optimize, and I think that's why Buffett wrote that letter, because he also wants to see that his money that is going to charity is well used. And I think Nick wants to see that it's well used, and he recognizes that it's difficult. It's a challenge, and that's why he's trying to do as good a job as he can on that front.
Great. So I don't know how much time you have for questions, but hopefully we can take at least 2 or 3.
Why don't we take a couple of questions?
Yeah. So I have a lot of people who requested. Let me just start with Samarth. Also, while Samarth is connected, maybe talk a bit about how much in your journey do you attribute to luck?
Well, I think luck is a huge part of the equation. So, like for example, in '94, I was vacationing in London with my wife, and I was looking for something to read on the flight back, and I picked up one of Peter Lynch's books, and I was running an IT company. I wasn't. I don't think I'd bought any stocks or anything till then or something. But I found that book really fascinating, and then I wanted to know more. I read the second Peter Lynch book, and then the second one is talking about Buffett. And then I was curious who this guy Buffett is, and I was very lucky that they were the first couple of biographies on him were out, and I kept going. So what I'm saying is that the fact that I even became an investor is total fluke. I could have picked up a book on a different topic, and the trajectory would have been quite different, quite inferior, I would think.
Mm-hmm. Samarth, do you want to unmute yourself?
Yes, am I audible?
Yes, please.
Yes, so Mr. Pabrai, you said that it's hard enough picking the stocks and understanding the trajectory of earnings. So why be bogged down by the macroeconomics? But for people who want global diversification, their best resort is index funds. And don't you think understanding macro perspectives for index funds and for global allocation is important?
Well, I mean, I think if you have a good understanding of, where things are going to go, that's wonderful. But I think it's really hard to do that. So I think trying to figure out. I mean, let's take a situation. I think this year at the Berkshire meeting, I got, and I don't know, a lot of people picked up on this or not, but I got a distinct sense that both Warren and Charlie do not think that the odds are zero that Russia will resort to nuclear weapons. Basically, they're getting backed into a corner, and you got a megalomaniac who's getting backed into a corner. He's got this huge nuclear arsenal. Uh, he may decide to use some of it, and they kind of they wrapped it in some jokes, etc. But the thing is that the odds of us having a nuclear event, nuclear weapons, at least like one or more set off in 2022 is not zero, and it's not even. I think it's more than 1%. I think it might be even 5%. I don't know how to place those odds, but that's an example of why this stuff becomes so hard. How much do you want to overdose on that, and how do you want to think about some factor like that? And so I think that if you were globally diversifying, dollar cost averaging, and going in over time, and yeah, equity markets can do whatever they do, but if you have a long enough runway and all of that, uh, it's probably the best way to go. I think trying to answer these types of questions is really hard.
Shafalika?
Hello, hi. Thanks for the opportunity, Sandeep. I would like to ask Mr. Pabrai, what is his outlook on India from an investment point of view for the future, given the current global scenarios?
Yeah, I think India has a lot of promise and a lot of long term tailwinds. Um, the sad part about India that I always find is that there is so much low hanging fruit, which would make the country so much better and wealthier, and people's standard of livings would rise if a few of these changes were made, and they're very obvious changes. Some of them are maybe politically might be a little bit difficult, uh, but I just find that the entrepreneurial spirit and letting free enterprise do its thing is so curtailed and constrained in India that it just hurts itself in a major way. And we've seen, I mean, if you just see the trajectory China has been on and what it accomplished when it unleashed full on capitalism versus we are still very heavily rooted in a lot of government red tape and bureaucracy in a lot of areas. It's sad, but I would say even given all those realities, uh, I think India is a good place to be, and I think it'll do really well.
Apratim? Yeah.
Hi, am I audible?
Yeah, we can hear you.
Hi, Mr. Pabrai. Thank you for this opportunity, Sandeep. I just wanted to quickly mention, Mr. Pabrai, one of your jokes that regarding the Guinness joke in your Trinity College was a really funny one. But in terms of questions, I would like to ask in terms of is there any specific, from an Indian perspective, any specific growth sectors that you think are worth looking at from your perspective?
Well, I mean, I think that there are areas in India that will do really well. I think IT services, cloud, all of that will do really well, even though it's pretty sizable today. The issue that comes up is that many of these things can be obvious. I mean, if I knew that the IT sector would grow a lot, it doesn't mean that I can make money out of it. So then, just knowing that is not enough, because then you get to the valuations and individual businesses and all of that. So I don't think it's so easy and I actually don't look at things that way. I don't start at the top and then go down. I don't usually look at it like that. What I'm looking for is what I would call anomalies, and you can make a lot of money even when there is no growth, if the value is so compelling. I mean, like if I look at the Turkish bet I made, those guys are really good capital allocators. But if it did absolutely nothing to the business, we would still make 30 times when it gets valued fairly. So just to get from the value I bought to the fair value would be a 30x, and it's hard for them to destroy that value. So, and what they've actually shown is they're increasing that value. They're really smart about it. So I don't particularly go looking for the hottest sectors or the highest growth or any of that. What I'm looking for is anomalies, and I'm looking for what other smart investors are doing and why they're doing it, and whether there's stuff that I can understand that makes sense, and then take it from there.
Doctor, you're the last person for a question. We've taken a lot of time from Mohnish, so we'll take that as the last question.
Thank you, Sandeep, for the opportunity. I wanted to ask Mr. Mohnish, what do you think of the idea of buying nets at the current market? Do you think it's still compelling, or is the anomaly gone?
I mean, I think net nets can work as long as they're not, going to, like in the .com era, we had a lot of net nets, but they were fake in the sense that they were going to destroy all the value there was because they were bleeding so much every day. So it was an illusion that those stocks were cheap. Yeah, but if you can find real net nets, it can work out. It's not an area that I have much interest in anymore. It took me a long time to learn that. See, I think the one thing about the stock market is that there's like 50,000 stocks globally. Whatever criteria you set, let's say you say that I want to buy net, so I want to buy PE of ones, or if I want to buy anything that's less than PE of 3, or I want to buy 10 baggers, or 100 baggers, or 1,000 baggers, whatever you set as your criteria, if you stay focused on that, you will find it. That's the amazing thing. There are 1,000 baggers out there, 100 baggers out there, 10 baggers out there, 2 baggers out there, PEO ones, nets, all of the above. And so I decided for myself that I like the multi-bagger game. It's kind of a fun game. It's a lucrative game. And so that's where I want to put my energy. But I think if you decide to put your energy on nets all in, you will do well with that, because they are there and they're overlooked and all of that. So that can work out quite well.
Great. Thanks, Mohnish. I think somebody on Twitter asks if we can find stuff on Nick Sleep. I think there are semi-annual letters which he has written, which are available on a site. I posted on in Twitter. You could go to that. It's called igyfoundation.org.uk. Those are great letters, and I'm sure Mohnish would endorse that. With that, thanks so much, Mohnish, for being here, taking out so much of well over 1 hour 20 minutes of your time, and thanks once again for being here.
Well, one thing I just wanted to say, Sandeep, is that, and I wanted to say this to all the listeners, I gave Sandeep a big challenge when we were going to do this. I said, listen, Sandeep, here are the rules of this session. Number one, don't send me any questions in advance. That really makes it very non-fun for me. Number two, don't ask me any questions that I've answered 20 times before. So the second one was hard for him because he had to go probably listen to all kinds of videos and whatever, which I'm sure he spent a lot of time doing in the last few months. And actually, I have to say that this was a very fun session for me, especially because you followed that second rule. So I answered a bunch of questions I've never answered before, which was fun for me. And I think they were just wonderful questions. So thank you very much.
Thanks so much. Thanks everybody. Sorry we couldn't take all the questions. We have 20 more questions. We hopefully Mohnish will give us time another time next year. Till then, thanks everybody and good night. Bye.